Oh, look, I think you got all. I mean, you really got every possible type. If a strategy can make money, then it probably exists, and you've got a hedge fund set up around it. I think. I mean, you've probably seen the same yourself. I think they're becoming much more systematic. Right, certainly the discretionary traders, like we were talking, those trade the news when we used to trade the news back in the good old days. They're sort of gone because they just don't have the speed of execution that the the algos now have. So I think certainly a lot more systematic than they used to be.
So is it more? Would they employ more fundamental or technical analysis in hedge funds? That is when they're employing their trades.
I think it's first and foremost it's IT related. I think a lot of it's around the technology. What are you able to bring in terms of technology? I think that's number one. And secondly, I'd probably say it's technical analysis.
What about the macro funds? I mean, macro funds traditionally used to take very big macro views, hence the name, and was more fundamentally based. Are they few and far between now?
Well, becoming fewer and further between. I think they've had a few. Maybe the last 5 to 7 years have been pretty bad.
Right.
I think for the macro funds, I'm not mentioning any names, but I think a lot of the ones that had 15 billion under management some years ago, they're I'm not going to say gone to the wall, but I think they're much less prevalent than they were. So that's my experience anyway. Yeah.
And what about you mentioned the systematic traders, the robots versus humans? I mean, what is your view on that, and how has that changed trading?
Well, first of all, from the investor perspective, it's much easier to invest in a robot than it is in a person, because with the robot, everything's systematic. Everything about the system is systematic. The risk management and the execution, everything's systematic. So they can understand, they can tick all their boxes, and it's easier for them to invest. So I suppose that's first and foremost. That's why I guess the robots are, and the AIs, and they're just much more attractive, I guess. And just I think that, I'm not going to say they've completely taken over, but to a large degree it seems that they have.
Would you say that because the emergence of the robots and the traders and their speed in accessing the markets, is that eliminating the ability for traders to trade the news? And we just cannot read the headlines as fast as a machine can.
Yeah, you're dead right. And we just cannot read the headlines as fast. So it's more about reading the machines. I think it's more about the trader adapting themselves to, rather than trying to pick the news, pick to what the machines are going to do.
Yeah.
Like for instance, if the news comes out bad, then it's just going to gap straight away, and then it's going to give you a trading opportunity if you're just a clever trader who knows how to react to the machines, what the machines are doing. So it's a changed world for sure. Yeah.
So getting back to the human trader, what's the maximum drawdown that you would tolerate from a trader?
Like a monthly drawdown, it depends whether it's like a fund manager type or a sort of a prop trader type. I sort of make that sort of a differentiation. If it's a fund manager type, anything more than probably 1.5% per month, you're not going to attract any significant investors if you were showing those sort of drawdowns. And if it's sort of what we call a peak to trough drawdown, if you're showing anything more than say 10%, as a fund manager type, I don't think you'll attract a lot of investors.
So you really have to have the ability to preserve capital as well as create wealth.
Yeah, and you almost have to work. You almost have to work backwards when you're building a business. You almost have to sort of build all that into your risk management system and say you can't go there. So that's the fund manager type. I think in terms of what we call the prop trader type, the market's more lenient, because it's the sort of different types of investors there. Again, though, certainly 5% per month, I wouldn't even go close to there. Maybe something in the region of 3.5% to 4% per month. If you're showing anything more than that, I think it's just going to, if you just put yourself in the investor's shoes, it's going to frighten you away, I think.
Yeah, well, what happens if one of your traders does go off the rails? I mean, what sort of action do you take against it, or do you take action for losing your money?
Yes. Well, first and foremost, I think it's now much easier than it was in the past when it was all fund related. So now most investments are like more in a managed account type structure, and it gives the investor immediate access to the account. So we can close the account like straight away. So that's, I mean, that's the first step, I think. If the trader oversteps his parameters, is just shut the account down.
Yeah.
In terms of, there's not much we can do really then in terms of, any other action apart from, advising other investors to avoid that trader.
Yeah.
I guess.
What about if the trader has a bad run, but you understand his methodology, you understand what he's trying to do, but say he's looking to find a trend, or his system is to look for trends in a market that doesn't trend for a while. Are you more tolerant of that trader and perhaps encourage him rather than sort of scold him?
Oh, definitely. I mean, I never get involved with it. I don't tell the trader what to do. The trader does what the trader does, and we trust their professionalism and their ability. What we may do is reduce their allocation slightly if they're in a bit of a down phase, but we all know it's coming. Even if, as a day trader you might have 2 a month, as a longer term trader you might have 2 down months a year. We just know it's going to come, so we just have to ride them out. As long as they stay within their sort of parameters, we just, let them do what they do. Yeah.
And what sort of currency pairs or instruments in general are preferred in the hedge fund space? What are the most attractive? Is it a liquidity issue, or is it?
Yes, certainly with the bigger ones it is a liquidity issue, but it's pretty deep now. The market's pretty deep, so you can trade all the emerging markets, and so I would say what we used to call the majors, which was maybe 7 to 10 pairs, is now probably 25 pairs, including sort of the major is that the wrong way of putting it? But the major emerging markets in Europe and Asia. Yeah. And even since the U.S. election, the Mexican peso has become very. Lots of people like to trade because there's volatility.
South African rand on a Monday morning is pretty exciting.
Love it to death. Yeah. Kiwi rand and Kiwi rand in large. So volatility is hard to find. So some types of traders are just chasing that all the time, and that's what they.
So liquidity is improving. So what is the typical leverage used by hedge funds in your experience?
Yeah. So probably in hedge funds, I would say 3 to 1, maybe would probably be a maximum, I'd say. And then as you get more into the prop desk type environment, maybe up 10 to 1, maybe at a stretch. Yeah, so I think because accounts, people are going to blow themselves up pretty quickly. But in terms of building a track record, I would not be doing it on 50 to 1 leverage. It's and not very many people are going to give you money and give you $2 million and say, good, leverage it up 50 times and get busy. That's just not likely to happen.
Yeah, and also open the question up, what, in your view, is the ideal trader, or is there such a thing as an ideal trader?
I think that's a very broad question, John, but I think that there are so many different styles of trading, so many different ways to trade, short-term, medium-term, long-term. And touching on a previous point about return and leverage profile, it all maps back to risk-adjusted returns, and therefore risk management is crucial. So if you look at or think about the crucial ingredients and variables of the ideal trader, it revolves around an ability to have a plan, and that's not just a risk management plan, but an actual strategy, and stick to that strategy. And whether you are strong at trend trading or intraday trading, know what your strengths are and be able to be disciplined enough to stick to the risk management guidelines.
Yeah. So there really is, it seems that they used to say in golf, there's no one way to hit a golf ball. There's a lot of different ways you can trade. And so really what you're saying is consistency and sticking to a plan, sticking to the guidelines, for risk management guidelines. What about courage? What do you feel about?
Without doubt, the best traders we've seen in time have a large degree of courage, but also have a sense, a groundedness, which I don't know if you'd call it humility per se, but
the courage to admit they're wrong.
That's exactly right. Courage works both ways.
Yes,
you've got to be able to stick with the winners as well as be able to cut the losers, and both take courage.
Yeah, I totally agree with that. Okay, can you give me an example of a trader that who's gone on to make it in so many words, who's been a very good success story?
Perhaps not, I won't talk about individuals per se, but the different, might be worthwhile to highlight a couple of different youngsters as they were that came up through the grades in football parlance. One in particular was very academic and needed to rationalise everything, and everything needed to make sense. And of course, financial markets, regularly things don't make sense whatsoever.
Paralysis by analysis.
Yeah, absolutely. And this chap had spent a great deal of time in the first 12 months beating himself up, and over the course of time though was able to train himself to understand that there's going to be X% down days, X% of times that things don't make sense. And over the course of the years, because it is a psychological game as much as anything, this person was able to develop their psychology and mature into a much better trader, because his analysis was fantastic, but understanding the randomness of the market, he trained himself.
You have to juxtapose that analysis with market savvy, and that's
absolutely. And then the other chap was somebody who was more the other side of the fence, was much more interested in just looking at the market and letting the market determine his view, and that meant that actually was very shy of taking risk. Was very reluctant to get involved because there was no textbook to tell you exactly how it was going to pan out. And so for the first couple of years had a tremendous win-loss ratio, but hardly made any money.
Yeah.
And this person was able to adapt, and I think that's a key thing. Getting back to a previous discussion or previous point there about the nature of the market, the ability to adapt to the current type of market is essential, and that's not just reading the market, it's understanding yourself as well. So it's a dynamic proposition.
If you don't mind, if I jump in there for a second, John, just purely in terms of the retail side, which is, we've seen probably 3 to 5 traders over the last couple of years make the leap from just trading their own account into starting to manage funds. And I think also with them, it's the one what they're able to show is the ability not to blow up their accounts. And it sounds silly, but that, I think in terms of the retail trader,
and a lot of that's psychological too, isn't
Yeah.
it?
So I think yes, and they have that in common. They've all got and I'm not talking, I guess they have a career in mind as a trader, and for a career for them means they're going to try and make money as a trader, and they're going to try and build their money up. And that's the point, I know, but it sounds, everybody tends to forget it.
That's right.
But that's what they start off doing, and they're good at that, and they're able to develop their skills in terms of managing more money as they go. And it's not about being systematic, or like Dave just said, or any particular type of trader. It's that the mindset to be able to start here, and I'm here, and I'm going to get to there, and this is the pathway.
War. They're going to make money.
They're going to make money. They understand that.
They forget that sometimes. That that's the point of the game.
Yes, I know. Yeah.
So I mean, if you do find, from a Usain Bolt, a superstar in the making, I mean, what could they expect, in terms of funding, support, remuneration? What is, what's the pot of gold for that? Right.
Well, I suppose the good news is that it's become investment funds have become a lot more accessible. It used to be, when we were starting off, if the bank didn't fund you as a trader, like setting up your hedge fund, it was very difficult to get started with your initial allocation. Now with the retail space, it's become a lot easier. So if you have a 2-year track record, which shows that a lot of the characteristics and criteria we just talked about, that ability to build funds and not have the massive drawdowns, etc., and a steady plan, I think you can expect to have something like, say, $10 million under management quite quickly through the retail brokers. Now, generally in that, you don't get a management fee, you just get a performance fee of, say, 20 to 25%. Yeah. But with a $10 million, that's not called an allocation, it's called a trading line in our terms, like a trading limit. So you've got the ability to make quite a bit of money. And if you prove yourself there, then the next step is probably to go and get your own license or to work with an existing hedge fund. The opportunities are the same as they were, I think, in our day. If you're good, you make a lot of money very quickly. And unfortunately for me, the really good ones make so much money very quickly, they just go and trade for themselves. Yeah. Yeah.